difficult times, I think, in the world, difficult times on the stock markets. I will start. I will discuss a little bit about what's going on in the world, what we can do, how Hugo can help you, and then Inge will discuss everything about IT, if you still should invest in it. If you are an investor and you watch your portfolio at 5 o'clock and then you watch it again at 5:15, it can be a huge difference. I think that's also difficult for us as investors. What happened on this year on the 20th? But this is what happened, and that changed the world a little bit. And I think this is a difficult world crisis, but if you look at what's happening in France and what's happening in Germany, this was from the Financial Times today or yesterday, don't remember, how they tried, of course, they increased the budget, so they can probably spend more. Germany does need to spend more, and where they're going to spend it more on infrastructure and on defense. I think I don't have to explain to you what's happening in Europe about the defense sector. A lot of people don't realize yet what's going on and what it's around the corner. I hope that everything will be solved on a worldwide scale, but I'm a little bit afraid. And when you see the 20th January effect, what kind of effect did it have on the stock market? It was when Trump was when he had his inauguration, and after that, markets went down. First you have to suffer, and then you can gain. I hope he's right, but I'm doubting. I'm quite negative. But now something positive. This is a little bit for the people who don't know us. This is our background. I was a co-founder of the first online broker in the Netherlands. It was called Alex in 1999. So I'm a little bit in this area a dinosaur. We were taken over by Pink Bank, that's a Dutch bank, and then Saxo Bank. Probably you know Saxo Bank because a lot of Swedish are in the room, and Saxo Bank is a Danish bank. So probably you know Saxo Bank. And 5 years ago, we made a deal with Saxo Bank and Pink Bank, and we took over the business in Spain. So we are now an independent broker, and we are the only licensed stockbroker, Spanish licensed stockbroker in Andalusia. We are regulated, so everything what we say, what we do is checked, and we work with two other brokers, the biggest broker in the world, Interactive Brokers, and Saxo Bank, that are our two partners. And so we offer their bank accounts, so you have a bank account with us, but on top of that, that's our service. What we also are doing, because I think that investing is quite difficult. With us, you can buy 50,000 different things. That can be like bonds, that can be ETFs, that can be mutual funds. So if you are a starter, how do you know how you should begin? It's hardly impossible. You can go to YouTube and you can look everything up, and then really young people, 25-year-old, they say, I made millions with investing, not regulated, so they can say whatever they want. And you can look, you can find everything. But we made online courses, and that are interactive courses. And if you look at the pyramid, how we human beings, how we learn, there are all different kinds of learning methods. And what we do, because it's interactive and it is a hybrid model, so we human beings are also involved, we go through this whole learning process. We provide courses on a product level, on an experience level, packages, everything what you need to know when you are successful on the stock market. The ideal portfolio, I don't believe in it, because I think we are now with 40 people, you're all different people, you all have different needs, you are all different. And I think you also should your investments like that. Every portfolio should be different. Of course there is a big overlap, but you have your special needs. I only believe in a tailor-made solution. And how we work, with different approaches, but at the end, this is quite simple. This looks like Lego blocks, but this is how you should build up a portfolio. But this, how you should look at your portfolio. And this is really simple, but if you drive home or you sit tomorrow behind your computer, I hope that you look at it, okay, what's happening in the world with all the problems. Do I have a portfolio that I think that is protected against the things that maybe can come. This is the forecast of the AI bubble that we used in 2023, 2024, and it is expected a yearly growth in this sector of 37% on a yearly basis. And we divided the AI sector in 3 subsectors. Inge will talk about that now, and that's what I want to close off, is that if you are an investor, that's what our vlogs are mainly based on sectors, because if you believe in a certain sector that it will grow, that is more important than picking a stock, because if the sector grows, you must be really unlucky if you pick some stocks out of that sector that don't grow. And if you look at the AI sector, it's a really big sector, it's expected to grow, so if you just pick the wrong ones, then you're really unlucky. So you can better do that together with baskets. And Inge is a basket builder. It's a basket builder because he has 2 funds, and I think they're really 2 really specialized funds. So that's why I invited Inge to talk about mainly your IT fund. So Inge, please, if you can step forward.
I'm representing a firm called Chelverton. It's a global fund manager in London, where me and Jenny Hardy works. We represent the tech team, global tech team at Chelverton. We invest in technology company with high return on invested capital, and I'll come back to that later. That's a very, very high focus from us, which really means that the money they spend on R&D and investing in machinery and equipment has to have a high return back to shareholders and cash flow. They are profitable and generate strong cash flow. That's another thing. All of our companies generate very, very strong cash flow. And that's really, really key for us. Our investment horizon is 5 to 10 years. So if we can't see where these companies are heading in 5 to 10 years, we're not investing. Our long-term performance in the fund, the long fund started in 2019, has been 26% a year, average every year. With that said, we're down quite a lot this year due to US dollar and weak performance of technology. I also think it will turn around, and I'll explain why. So why technology? Why do we look at technology at all? It's growing, but it's not growing much faster than GDP, but it's still growing faster than GDP, 2-3% a year. And that's really, really important. But for us, when we look at technology, and especially at these times, it has clearly higher volatility than the markets. And when I was head of trading at ABN AMRO and we had bad news coming in, the first thing we were screaming at the floor, the big trading floor, was hit technology. Doesn't matter if it was good or bad. It's like, that's where the liquidity is, that's where you have movements, so hit it. What you really want to look at is the performance of the company. That's the real risk. If you're sitting on companies not performing, that's the biggest risk you can take. How do we handle that risk? We diversify the portfolios. We have a number of different sectors inside of it. But we always start with the question, what if we're wrong in our scenario? Our 5-10 years horizon scenario. What if we're wrong? How wrong can we be? How badly can it turn out? We use insurance companies that are profitable, have strong cash positions, and generate cash flow. So what do we really do? We are trying to find the winning trends. And what I'm saying by that is like, we're trying to find areas inside technology that's going to grow faster than the GDP, 2-3%. And NVIDIA had a very, very difficult time, but we started investing heavily into AI at that time. And in May, we wrote a quite big piece into Wall Street Journal, if you Google my name, saying that everybody in the market is wrong on NVIDIA. You're going to beat by 50%. And they're going to do it in like 3 or 4 months. And I'll tell you later why we knew this. So that's really what we do. And then we look at, after that, we're finding the winning trend, we're looking at financial productivity, return on invested capital again. And what we end up with is companies that are almost monopolic or oligopolic. So every company we own have like 60 to 100% market share. Valuation and downside. Once again, looking at the downside first, because the problem with me and my own money, which is in the fund, and my clients, it's not going to be if we're right. It's going to be when we're wrong. Okay, let's look at the downside. If we're wrong, how bad can it turn out? And then we have something called trading overlay. We are very, very active traders. Normally we have like 30 names in our portfolio, but we trade on a daily basis. So even if you have 30 names, which you believe is going to be really, really good investments in 5 to 10 years, it doesn't need to be a good investment tomorrow. So we have a trading overlay. What I mean by that is, if we go into Q1 numbers now, which is coming in April, after January, February, March is coming into the books, we have 30 names in the portfolio. We check all our data points and say that out of the 30 names, we feel that 5 or 6 of them is going to be better than expected, 15 is going to be as expected, and 5, 6 is going to be worse. Why hold the 5, 6 that are going to be worse through the reporting season? Why don't we sell them and buy them back after report? And increase the position in the ones that are going to beat. So that's what we do in trading. Why sit on things? There's liquidity in the market, sell them, buy them back. You don't need to own them every second, even if you like them. What's happening then? What do we look at when we talk about this return on invested capital? Because if you think about it, in any business in the world, you have a return on the business you have, and then you want to grow the business. Almost in every single case, you can grow it, but you're going to struggle to get higher return, especially if you put in more money into it. We want to buy large companies that invest more, that bring up the returns. So completely the opposite. If you go to university, everybody's going to tell you return on invested capital is going to weighted average cost of capital. You can't get more returns on weighted cost of capital. True, and that's why every single business model ever any analyst done looks like this. It goes from return on invested capital of one level, going to back. That's how every model in the world is built. And we argue it's probably right in the long run, but it's going to be a number of years you're going to be wrong. Return on invested capital can go up. And this is a great example. TSMC in Taiwan. They used to spend $10 billion a year. Then went to 20, then to 30, now they're investing 40 billion this year, and returns are moving up. So they're returning even more money, even if they throw in more money into the pot. That's the type of companies we want to buy. January they grew 34% year over year. February numbers are out also, they grew 43% year over year with that size. That's one of the biggest holdings in our portfolio. PE 14 next year on consensus numbers. On our numbers, 12. The market is saying it's a risk. Trump may be putting tariffs on them and so on. I'll let him do it. They're just going to pass it through. Because there's no choice. Nvidia has no choice. They have to go there. There's already pass-through clauses in the contract for the two biggest costs for them, energy and water. And if you look at Taiwan, there are massive problems with both energy and water in Taiwan.
And what about the China risk?
And China risk. But if the China risk happens, I'll tell you, go home, close your door, close your windows, stay home for 10 years.
Yeah, but you are very optimistic about TSMC, which is a fantastic company.
Yeah.
All the criteria are met, without doubt.
Yeah.
But the China risk is not addressed.
No, because what I'm saying is that if China happens, GDP global is going to fall 10%. You can't hide. Whatever you have, your house, everything is going to die. Except gold, maybe cash, maybe. Because you're going to struggle everywhere. Because the problem is you're going to be hurt everywhere. And it's like Warren Buffett. I don't know if you remember, he was a big owner of TSMC, sold it, and he said, I don't want to have an exposure to Taiwan because of the Chinese risk. And he sold TSMC 80% of sales in Taiwan, 20% in the rest of the world. But he kept one stock in the portfolio, and he still kept one stock in the portfolio, which is the biggest holding by over 50%. What's it called? Apple. Where is Apple's every single processor built? 100%? Taiwan. So you get 100% and it's all the thing where we should 80% exposure. So that's how risky Taiwan is. No Nvidia product, no AMD product, and I can go on. The areas we are invested in now is cloud services, which is, I think, the key to turn around in the technology market. Semi-capital equipment, which most people never heard about. It's traded extremely volatile on the market, but look at the returns of these companies. Software productivity, we like companies like ServiceNow, which is just a fantastic company, creating a platform where everybody else puts their applications on, so they're the bottom layer. Very, very good for AI. Cybersecurity and digital services. Those are the areas where we focus, where we can see here is the structure, here we can make high returns. So what we do is really, we look into these industries, into the smallest details. A lot of people say, you travel and meet the companies. Yes, absolutely, but I'd rather meet the clients. I'd rather meet the competitor. So what we spend a lot of time is to building the ecosystem and also to check everything ourselves, second check. We don't own anything in China, for example, because we can't check anything. We can't be ahead. We don't have a good view on the political system and how they're going to decide things in China. We want to have companies where we can go in and say, okay, this is check, this is check, and build a model externally and look at it. These are the three nodes that leads the world. 7 nanometer, 5 nanometer, 3, the most complicated nodes in the world. And those are the lead. Now it's going to be 2 also coming in Q4 this year. But remember, this is where we wrote the note to Wall Street Journal here. And we wrote the note and say Nvidia is going to blow away numbers, going to grow a lot. And the reason why they did that was due to Apple. Because Apple's new phone came out and we track every single component in the world. We know exactly what we're going to produce, size, and the only question is the volume. But we can also see roughly where the volume is going to be. So Apple was moving from 5 to 3 nanometer. So Apple went from green to red, freeing up capacity on green, and who took that? Nvidia. Nvidia had a profit upgrade in August, and that's how we did it. So if we can track all the components going in here and look at this and say, okay, what's going on now instead? How can we be on top of the game now? Why was I so cocky with TSMC? Let's get back to the US. 2 years ago, Biden cut the ribbon in Arizona and Texas for the first TSMC factory in Arizona. That was on 5 nanometer. That went live with production in October last year. Started building like 4 years ago. They cut the ribbon 2 years ago, and now they're producing the watch, the new graphic card from AMD, and the old iPhone on 5. The next factory they're going to build, they're starting now, is going to be on 3 nanometer, where you have the mobile phones today, you will have AMD's next chip, 3155, coming, and you will have Broadcom's Google chip coming, but you will still have Nvidia here. This year, next year everything will move, and this factory goes live 28, 29. So that's the time horizon. Okay. And then 2 nanometers coming in Q4 this year. That factory is the third factory TSMC is talking about, and that's 2031-32. It goes live in Taiwan with 3 factories this year. So this is such an important chart to understand, and then digging into every single components come out. Like, take Apple last week, you had the M3 Ultra for the new Mac, you had the M4 coming out. You break it down, see, okay, where is the ship going, what volumes, and then you can build it up from there. You get the capital equipment guys supplying into this, and say, okay, so what new factory do we need? And then you spin it on and on. And you have a quite good view what's going on in the world. So these are just the leading ships. So, and I'm just going to tell you the final thing. We don't know how 2 is going to look this Q4 when it comes out, but this, and this. Apple went to TSMC and said, we're buying 100% capacity of you guys, nobody else gets chips. That happened for 3. And then going back to how Nvidia thinks, if you look at Nvidia's latest quarter result, they had prepaid $45 billion in purchase commitments for capacity and memory so they can produce this year. 45 billion in the last quarter. So how do you invest? How do we invest? We invest in things that are structured, few players, leadership, good models. We don't invest, even if Palantir was the best stock in S&P 500 last year. We don't invest in things where it's commoditized, the business model is not really set, and we don't know how many competitors going to be. So the deep-seek effect, everybody was negative, traded down the stocks, but what really happened was that the data centers just exploded with growth, prices on the ships flew, and if you have time, this Nebius, it's a Dutch company called Yandex before, a Russian company, redone itself, now a data center company. They had a really interesting conference call. You can get a hold of them and read what happened with their demand in January when DeepSeek came out. It just exploded. And if you look at the price, it just exploded. So DeepSeek negative or positive? So far, very, very positive. So that was really my presentation.